For the lunch break, I know it is challenging, but I have brought with me a challenging topic, and as my preceding speaker said, MiFID 2. I mean, that's the M word, that's everybody is dreading. And in my presentation today, I will look at MiFID 2 testing requirements. So a bit more specific than we do cover the RTS 6 that you just saw, but more specific on the testing requirements. But I also bring in the RTS 7 as another very interesting RTS that is relevant for exchanges, so for trading venues. So just a bit of information about me. I am the head of the Xitaro exchange system development, so I'm responsible for developing our exchange system, which we have actually introduced in 2015 after a 2-year implementation project. And now I'm heading our MiFID 2 implementation project, which I'll talk about in a few seconds. Is it the white button or the other one? Oh, it's a white button, great. So here's a little agenda. And first of all, a couple of slides about Boerse Stuttgart. Boerse Stuttgart is an exchange in Germany, the second largest exchange in Germany. A couple of things about our MiFID 2 implementation project. It's a 2-year project, which we extended to 2 years because first we thought it would be 1 year, but then MiFID got postponed and we suddenly had 2 years at our hands. Then the overview of the MiFID 2 testing requirements on investment firms and trading venues, and some conclusion. First of all, where's Stuttgart? Stuttgart is in the southwest of Germany and is the capital of Baden-Württemberg. So what is Stuttgart known for? Stuttgart is known for Porsche. Porsche has its headquarters in Stuttgart. Daimler, Mercedes is headquartered in Stuttgart as well, and Bosch. Bosch as a world-known branch, and of course Boerse Stuttgart. So Boerse Stuttgart, and here you see, I guess, one of the last trading floors of an exchange in Europe. So we actually have traders sitting there on our trading floor. Of course, it's an electronic trading, but we have a market model, which I'm talking about later, that uses specialists like intermediaries that are on the trading floors that care or that ensure the quality of the execution. So here we are. Boerse Stuttgart is not only the second largest exchange in Germany in terms of turnover, it is also the market leader in an asset class in Europe, which is called securitized derivatives. So together with our subsidiary company, Nordic Growth Market, the Nordic Derivatives Exchange, we have about 1/3 of the market share in this asset class in Europe. This asset class is a very peculiar asset class. We actually have 1.5 million instruments listed on our exchange. That is quite difficult from a testing perspective, of course. It makes the system huge. It needs to be very performant. And any of these 1.5 million instruments can be traded instantaneously. So these have to be in the trading system, and that was one of the criteria to select the new trading system that we implemented in 2015. So we do trade all asset classes. We have equities, we have debt instruments, investment funds unit, all on the cash market, but we have 1.5 million securitized derivatives. And this kind of security, this kind of asset class needs a special market model. And oh, by the way, in Europe, within Europe, taking all the asset classes together, we are within the top 10 of Europe's stock exchanges. So even in Europe, we can say we are not far off. So I'm talking about the market model, and for the 1.5 million instruments, securitized derivatives, you need a special market model because somebody has to take care of liquidity, providing liquidity, making sure that the quality of execution is okay for the private customers. So we do have 2 entities here I'm talking about also in this presentation. We have the EUWAX, that is the QLP on our market. The QLP is a word that we come up with 10 years ago. It's a quality liquidity provider. So EUWAX is a company that is running the QLP system and is responsible for the quality assurance of the pre-trade information, the quality assurance of the order execution and liquidity provision on the market, so that investors are able to buy and sell whenever they want. And this is inherent in our Boerse Stuttgart market model. And there's, of course, the exchange system. So, and for the purpose of my presentation today, it's quite convenient because EUWAX is regulated as an investment firm under MiFID II, because EUWAX are doing algorithmic trading according to the mentioned Article 17 in MiFID II. And Boerse Stuttgart is, of course, regulated as a regulated market or as a trading venue according to Article 48 in MiFID II. So this gives me the chance to look at both requirements on investment firms and trading venues and present this to you today. So our MiFID II implementation project. That's a time span. What's not on here is a 6-month preparation project. So we actually started in the middle of 2015 because we still believe that we needed to be compliant with MiFID II by the 1st of January 2017. But then in the course of the project, it was delayed, thank God. I think everybody, I think most of the firms would not have made it to the 1st of January 2017. Neither would have the EU, by the way, or ESMA. So we came up with a 2-year implementation project, and I think the biggest part, and you can see it here as well, the detailed analysis of requirements. It started very, very early, and it's not finished yet. That's the problem. Because whenever we look at the requirements and we come up with questions and ask these questions to our regulator, they wouldn't answer immediately because they wouldn't know the answers either. So they would need to refer to ESMA. ESMA takes time, takes months to answer questions. And so the biggest problem we had in our MiFID II implementation project, or as we still have, is a moving target. We are working with a moving target here because we have built software on some assumptions which we think are reasonable, but if these assumptions do not hold, we have a problem because then we have to change software in order to have other targets. So that's the state, and right now we're in development, in testing. We have a major release coming up in October to be MiFID II compliant from the start of January. And we've had a lot of participant involvement as well. So we started a MiFID working group end of last year, where it was quite funny. Every participant there from the bank's side was still thinking there's some way to get away without doing something. So they were arguing with us, why is that and why do we need that? We said, we don't care, that's the law, it will be the law, and the ESMA would not care either. So I think we are now at the same page, everybody is doing it, everybody is implementing it, and I think it made very much sense to find a broad base together with the industry to come to a consensus what we're actually doing. Because if the industry is doing the same thing in a very consistent way, then it's very hard for regulators to argue otherwise. And so we are facing the last 6 months of our implementation project. By the way, just last week, MiFID was transposed into national German law. So that's, if you had started last week, you wouldn't have never finished before in time. Right now, I'm talking about some areas where we think are the most important areas in MiFID II. Apart from testing, there are lots of other areas. Of course, you may know, and of course you're aware of that. But I'm just go over it and tell you my opinion, our opinion, what areas are specific or are important for MiFID II as well. First area: clock synchronization. Clock synchronization, synchronization of business clocks. It is kind of a medium to large effort. It was a medium effort for us because we had to exchange hardware, we had to exchange clock servers, we need to build a GPS antenna on the roof of the data center, and there are lots of solutions out there. We've chosen one. I think we'll get away with it. And but this is also something for investment firms as well. So trading venues, investment firms do have to do clock synchronization. The second issue that is not so much an impact on trading venues, but a very high impact on investment firms. That's the APA, the Approved Publication Arrangements, to publish actually bilateral trades. So investment firms have to do it either themselves or they have to choose an APA provider. But there's a lot involved. We initially thought we would actually apply to become an API provider, so it's a very natural a path for infrastructure providers to also provide API services. We haven't done it. We have decided against it. It's quite an effort to do that. Quite an effort to comply with all the regulations. So and there are other very good API providers out there who offer competitive prices. So actually, Euwax is using an outsourced API provider to publish their OTC trades. Then transaction reporting is actually an interesting thing. Initially, we thought that was only for investment firms, but then we found out that trading venues have to report transactions as well if their trading participants are from non-EEA countries or if they are part of the European Central Bank system. So the Deutsche Bundesbank is a part of the European Central Bank system, and they are a trading participant in Stuttgart. So problem is they don't report their trades somehow because they're not required to. And now we have to build the infrastructure to report their trades to the regulator. So it impacts trading venues as well. And so you need, as a trading venue, you need to look at who is your trading participants. Are there any trading participants that are not required to transaction report? Then you need to do that for them. Then the fourth point, new transparency, order record keeping requirements. Order record keeping requirements is totally new for us. It was totally new for us for the exchange. So it's a requirement on the exchange, on the trading venue, to keep records, and whenever the NCA, the National Competent Authority, comes and asks for these records, you have to provide them for you. And it is also an effort for the trading participants because they need to supply more information, more IDs to you, which you then have to keep for 5 years. Reference data, as exchanges, we need to provide reference data to the regulators in a much more detailed way than before. And the challenging thing about the reference data provisioning was it was not only in MiFIR, but also in the market abuse regulation. MiFIR was delayed for 1 year, MAR was not. So we had to speed up a bit, and so we needed to implement that by middle of last year. So that was actually quicker than expected. It wasn't postponed. There is position limits reporting, position limits and reporting for commodity derivatives. As I said before, we run a cash market. However, we have derivatives, we have securitized derivatives, and according to this regulation, and very, very long it was unclear whether that was the case or not. According to this regulation, our securitized derivatives, where an underlying is a commodity, also fall under this regulation. So we need to do position limit or position reporting as well. That was unclear until last year, end of last year. So it was kind of a risk. That's why it's very high impact both on trading venues and trading participants, because our order flow providers, our trading participants who trade those commodity securitized derivatives, they don't have an infrastructure to report that, and they don't want to actually implement it. So now there's a solution underway with the help of our CSD, maybe to implement such position reporting, and let's look how that turns out. However, the problem was it was until last year, end of last year, wasn't clear whether we would be subject to that regulation or not. Then the prevention of disorderly trading conditions. I think we'll hear lots of that during today. But there's also the specific mention of pre- and post-trade controls, which exchanges needed to introduce, throttling, and so on. Quality of execution report. Exchanges must, and also investment firms, if they have systematic internalizing services, they must publish quality of execution report. Then we have the testing requirements, which I'm talking about today, and the tick size requirements, which may not be a challenge. What does that mean?
5 minutes left.
Are you sure? Okay. Because I thought I had a 45-minute slot. Can you please check when the next panel starts?
Yeah, you can go.
No, I want to be on time. I want to be on time. Because I haven't started with the actual topic yet. But I can speed up, of course, like last year. Tick size requirements. I think everybody is quite well set up now. So today's presentation is about the testing requirements. Now we come to the overview of the testing requirements. And maybe I won't bore you with the MiFID II requirements, but just for completion purposes, MiFID II Article 17 is on investment firms, and MiFID II Article 48 is on trading venues. And that's what we have already heard today. This Article 17 only applies to investment firms engaged in algorithmic trading. So if you're not engaged in algorithmic trading or provide direct electronic access or GCM services, then this regulation does not apply to you. So there might be investment firms out there where this regulation is not applicable. And the requirement on trading venues applies, and MiFID II actually says regulated markets shall ensure that, but it does not only apply to regulated markets, but it's to all trading venues according to Article 18.5 that just says need to be applied to MTF, OTF as well. So now we come to the RTSs. So the RTS 6, again, is for investment firms. We have heard a lot of it today already. And likewise, was very similar, RTS 7 is on the organizational requirements of trading venues. And when you look at the subjects, there's many similarities there. And so I've kind of put them all on one slide. And in my presentation today, I will focus on the dependencies between the requirements for investment firms and trading venues, and the commonalities and differences among the requirement groups. And I'm also trying to bring in some examples from Boerse Stuttgart, from EUWAX, as we have these two entities in our group where we need to fulfill the MiFID II requirements. So I've tried to reshuffle a bit, and this ESMA could have done as well, but I've taken the time to do that, to have 6 areas that I'm talking about today. Staffing, general testing methodology, conformance testing, testing environments, stress testing, and the self-assessments, which I think may be regarded as a good tool to explain your MiFID II compliance to the regulator. Staffing. You know what I did here? I've taken both articles and kind of merged them to see the differences. And it's quite clear that both entities, investment firms and trading venues, need to employ a sufficient number of staff with the necessary skills. I think that is kind of common sense. But the interesting thing is where the differences are. So the investment firms need to have an adequate number of staff with especially technical knowledge of the trading systems, algorithms, and strategies, because they are the ones running those algorithms, running those algorithmic trading systems, and that is the place where something really bad can happen if you do not understand your trading algorithms. Whereas the trading venues need to have an adequate number of staff with knowledge of the trading systems, and it's really written there, knowledge of the trading systems and algorithms, and that's important, and the types of trading undertaken by the member. So they do not really need to, in detail, understand their own trading system, because I think ESMA thinks that it's not a source of danger so much than the algorithmic systems of investment firms, but they need to understand which members they have, and what members use for trading systems to trade on their exchange. So that's the difference in staff, and of course there are legal obligations, and they need to document that. First topic, staffing. Second topic on the general testing methodology. The requirements, and this has been pointed out earlier, they may not be new, and you may already fulfill most of these requirements. But for the first time, it is actually written somewhere in the law that is directly applicable. So investment firms shall establish clearly delineated methodologies to develop, test such systems, algorithms, or strategies, and of course adapt their trading methodologies to the trading venues and markets. So that's the general testing methodology. When do they need to do that? Prior to the deployment or substantial update of an algorithmic trading system, trading algorithm, or algorithmic trading strategy. When it comes to trading venues, it's just written, make use of clearly defined development testing methodologies. Not very specific, but you need to define it. And as the preceding speaker pointed out, it is really the last thing that you usually do in development and testing. I mean, testing is the last thing you do, but documentation of testing is the very last thing. But here it's really pointed out, you need to have a testing strategy, you need to define and document the testing methodologies. Prior to deploying or updating a trading system. So not only the first time you deploy a trading system like 2015 Xitaro, but also when you have a major upgrade of the system. And also a very general clause, be able to demonstrate at all times that exchanges or trading venues have taken all reasonable steps to avoid that the trading systems contribute to disorderly trading conditions. That is kind of tricky, I think, because demonstrate at all times. I think it comes down to documentation, it comes down to regular stress tests where you test that your trading systems do not contribute to disorderly trading conditions. But demonstrating at all times, that doesn't mean, in my opinion, running those tests whenever the regulator asks you to. I think it comes down to documentation, to clear documentation that you have done or you can do to ensure that your trading system is safe. So the overall testing goal is trading systems, either investment firms or exchanges, trading systems do not behave in an unintended manner. I mean, that is quite sure, quite understandably. And there are also some other goals. Some apply to investment firms, some apply to trading venues. I think they go into the same direction, but for example, the investment firms' trading systems shall not contribute to disorderly trading conditions, and there's especially a mentioning of a switching off. So they should make sure that there's an algorithm or a mechanism to switch off their trading systems so that no other orders can be submitted. The third area I would like to talk about is the conformance testing. Conformance testing is pretty straightforward. Investment firms are required to do conformance testing. Conformance of the investment firm's system with the trading venue's system. So what do they need to test? They need to verify that the system interact as expected, verify basic functionalities, and test connectivity and recovery. What does it mean? Interact as expected. In Xitaro, we have done that 2 years ago when we implemented the new trading system. We have found that message flows, and I don't know, some of you may remember the talk I gave last year about the implementation. We have actually replaced a 20-year-old exchange trading system with a new trading system. So we wanted also to mimic the behavior. And it's very important that the message flows, so the messages flowing from the trading participants to the exchange and back are in the right order, in the same order that they were expected. So we have focused very much on the message flows, documented all use cases and documented all message flows. It kind of reminds me of the fixed orchestra idea. So you actually not only document the syntax, but also when do you expect which messages. And so we've documented that in these message flows, and it is very, very important to describe and correct and test the correct message flows in the different situations. So for all the use cases, we have such a flow diagram. Verify the basic functionalities. That is also something we have already implemented before we rolled out our Xitaro system, because we have required our members to do a member readiness check. That is kind of just requiring them to verify the basic functionality. So we have asked them enter, modify, cancel order, submit an event-driven order, make an OTC trade entry, and so on. And so we've given them a list of test cases, and we had a proactive customer support, and we had sessions that lasted 2 hours, where we would go through these test cases together with a member before they onboarded the first time. And then we actually handed the test results to them and said, okay, now you're successfully checked and you can go live with a go live of the trading system. So that is what we've done before rolling out the new trading system. I think that is also something that we would done if a new member wants to trade on our exchange. Then we have the test connectivity and recovery. We do have failover data centers, so we have a primary and secondary data center, and our trading participants are actually connected to both of them. So if one fails, then there is a failover to the other data center. And this is also something that we have tested before go live, and that we offer to test every year within our BCP test program. So we are offering, this is not mandatory, but we are offering our trading participants to participate in this failover testing. So this is what we think we'll cover the conformance testing with. There's also a need for algo testing. So if the investment firms have or support algorithmic trading, these algos have to be tested, and to avoid contributing or creating disorderly trading conditions. This is when do they have to do that? Before they access the trading venue for the first time, or the trading venue changes the system materially, or there's a new or material updated algorithmic trading system of the investment firm. How? And that's very funny. The ESMA could have asked the investment firms to require them to conformance test. No, they have asked the trading venues to require their members to conformance testing. So it's very that's very funny, because we will write that in our due diligence and in our rules and regulations, that you can only become a member if you do the conformance testing. So it's I think it's a system of checks and balances, and that's why it's so good to see how RTS 6 and RTS 7 interact with each other.
Can I just raise one point?
Yes.
There is actually a separation in MiFID, a complete separation between conformance testing, which must be done with
Yes.
exchanges, and the testing for creation or contribution to market disorder,
Yes.
which has to be done if your algo trades across multiple venues. It has to be done on the multiple venue microsystem. It can't be done on the individual exchanges. Individual exchanges can offer a system which effectively simulates
Yes.
multiple venues, but that's separate to conformance testing. It's not in the same article. It's a separate test.
Exactly.
Disorderly market testing. I think very few people have realised, because it's a huge difference. Virtually nobody does it now.
Okay, I think I'll cover that. Maybe it's a bit confusing because I tried to put that into the same area, but you're completely right. Conformance testing is not algorithmic testing. Conformance testing, I've written that on the same arrow, but conformance testing is something that the trading venues must require the members to do. And this consists of these 3 items: interact expected, verify basic functionalities, test connectivity. And trading venues must provide a conformance testing environment for the investment firms. So they need to conformance test. The trading venues submit the conformance testing results report back to the investment firms. And now comes the algorithmic testing. Investment firms are required to do the algorithmic testing. They are not required to use the testing environments provided by the exchange. So exchanges must provide a requirement for algo testing as well, but the investment firms are not required to use it. However, they have to, one second, however, they have to certify that their algos do not contribute to disorderly trading. So they need to certify it, and they need to explain how they have tested it to the exchange, but the exchange does not require them to test their algos on the exchange. Is that correct?
Absolutely. There's a couple of key points around this. I mean, one, they've got to test their algorithm across multiple venues if that's the way the algorithm operates. And secondly, the algo test system, an exchange isn't obliged to offer an algo test system. It can, and it was up until September 2015 with the draft RTSs. It had to, and the exchange was responsible for doing the testing. It was completely turned around, and now it's the investment firms responsible. The exchanges can't allow them to trade, exactly as you're saying. And nobody's realised that, RTS 7.10.1. If you talk to any number of tier ones, they haven't understood the venues have to turn them off.
Yeah, maybe that's also, that's a product of the changing regulation, of the changing drafts, of the moving target I was talking about. This is all based on the latest published versions. So let's go one step further. I think we're talking about the algo testing environment. But first I want to point out that the exchanges will put all of that in their rules and regulations. It's very easy. So the effort for the exchanges can in many cases be just add to their rules and regulations and require the members to comply with some more rules. And that's of course what we'll do as well. Now we come to test environments, because there's a whole section on test environments. And of course investment firms shall use their own testing environment that is separated from production. That is also something that you would have expected anyway, including all necessary sounding systems, and also use a testing environment for stress tests. So here are the stress tests. Stress tests are done separately on a separate environment, on the testing environment, but they're not necessarily connected to the exchange. So there are no common stress tests, at least they are not required. The trading venues, of course, provide a conformance testing environment. And for this environment we're talking about here, we need to require our members to use it. And we need to make it accessible. We need to put a list of financial instruments that are traded there. It must be available during general market hours or on a predefined, pre-scheduled basis. And of course there must be support to use it. And so there's a conformance algo testing again. Trading venues are also required to provide access to an algo testing that is as realistic as possible. But there is, as I said before, there's no strict requirement for members to use it according to the recital 13. And maybe this is also something that came up later.
It is. The exchanges have been given an option. And the exchanges lobbied very well and managed to get. This was the requirement. They had to provide that up until September 2015. Now they've got a choice. They can provide it, or they can provide only dummy instruments, and that gets them out of the exchange out of the obligation, but it does not allow the member to certify, because that's not a sufficient environment. A dummy instrument does not allow you to do the necessary realistic algo testing.
But according to what I understand is the algo testing environment does have to be provided by the exchanges, but maybe there are not so strict requirements on that.
It can just be dummy instruments now.
Okay, but they're still
help the members. So if what you're trying to do is to help your members
of course
trade with you, you want to provide the algo testing environment.
Of course, and then it comes to good customer service, and we as a stock exchange, as a trading venue, of course we want to offer better customer service than our competitors. And this is, I mean, we built up the customer service 2 years ago when we went live with Xitaro. Before it was a general customer service that was centralized for all the regional stock exchanges in Germany. And of course we want to be better than our competitors. And in our case, we are offering the same simulation environment that members can use for algo testing and for conformance testing, and that is actually production-like. That looks like production, has the same data going in, so it's not only dummy instruments, and it's the master data are updated every day. So it is quite a realistic environment. When it comes to stress testing, I don't really want to go into the details that maybe Anna provided before, and I don't have these animated GIFs, but I have another one like this, because we also did stress testing, and stress testing is trying to break the system, right? But what RTS 6 gives us here, it says what do investment firms have to do. They need to do high message volume tests and high trade volume tests. So this is actually required by the investment firms, and they need to do it using twice the numbers or twice the volume of the last 6 months maximum. There's kind of room to understand this requirement, because they don't say in what time interval, so it doesn't say per second or per month, so you may just look at the daily volumes. But this needs to be done, and this is the stress testing that needs to be done in the environment of the testing environment in the investment firm itself. In addition, and I am aware that this is another article, but it fitted quite nicely here, investment firms do have to do penetration tests and vulnerability scans to simulate cyber attacks. So I've just put it here as another testing requirement on the investment firm. And finally, trading venues do not have this requirement. So trading venues, what do they have to do? Simulate adverse scenarios, and they need to simulate, of course, their members' activities, because members are not on their stress testing environment. And so they need to look at an increased number of messages. So the baseline is the highest number of messages during the last 5 years, and there it is specified as a number of messages per second. So you need to record it for the last 5 years, and then you start there and increase the message volume, and see what happens. So hopefully nothing happens. And I've been told Xitaro is a very elastic system, so it doesn't break. Let's keep fingers crossed. But of course we'll do a stress test before the application of MiFID 2 to see if that is correct. And then we have to simulate unexpected behavior and a random combination of normal and stressed market conditions. So stress tests, just to conclude here, are done separately by investment firms, trading venues, with a bit different focus. So there's no requirement for common stress testing activities. Maybe that would have been too complicated, but I think everybody is happy the way it is right now. Last topic for our MiFID 2 area is self-assessments. You may be wondering why I bring that up here. And self-assessment, as I said before, I think we should see this as an opportunity to determine our MiFID 2 implementation needs. It's another way of saying to explain to the regulator, what are you doing, right? So both investment firms and trading venues have in their RTSs the mentioning of self-assessment, and they need to do self-assessments annually. And in the recitals, it is said that the compliance with the specific organizational requirements for an investment firm should be determined according to a self-assessment. And for the trading venues, it's they even acknowledge that they say, therefore some organizational requirements may not be appropriate for certain trading models. And I said, yoo-hoo, that is exactly what I was thinking before I read the MiFID 2. Because MiFID 2, it seemed to me, with MiFID 2, the EU wanted to solve problems that we've never had. Because our exchange is quite different from other exchanges. We are not a high-frequency trading exchange. We are not a venue where with market impact or stability impact. And we see this as an opportunity to say, okay, look, somebody has understood that markets are different, that their impacts are different, and there are appendices where you can actually say, okay, in terms of size and business and in terms of how large your customer base is, how are you affected by MiFID 2, and how will you implement the MiFID 2 requirements? So when do investment firms and trading venues need to do these self-assessments? It's an annual self-assessment. And so investment firms as well as trading venues need to consider the nature, scale and complexity of their business and perform the validation process to what extent, among others, to say how their overall compliance with Article 17 MiFID II is. That includes, of course, testing obligations, that includes organizational requirements. And they then issue a validation report approved by senior management. It's very similar for the trading venues. There it says it must be done at least once a year and at least before the deployment of a trading system. But it's the same. It includes analysis of all parameters, and we need to keep a record for at least 5 years. So it comes down to documentation, I'd say. So here we are again at the documentation problem. This, I think, everybody should take very seriously, because here you say how you comply with MiFID II requirements and can show to any auditor, to your regulator, how you understand MiFID and what you have done to implement it. And this we will be doing very extensively. And I think it also helps you in explaining your MiFID II compliance and in getting the right interpretation of implementing the MiFID II requirements. That brings me to the end, to the conclusion, and it may be a conclusion that can be picked up by the panel that takes place after me. If you consider fulfilling the MiFID II testing requirements a challenge, you might already have a problem with your established process today. Because after all, MiFID II does not require something completely new. And as the preceding speaker said, you should have done that already, right? But now it's in the law. So most of the requirements are probably already fulfilled by markets and their participants. Maybe not documented, but fulfilled. And what is good is, of course, that MiFID II imposes the same standards on each investment firm and on each trading venue, make it a level playing field. I know for some entities, for some firms, it's a probably deal breaker, and they may not continue their business after beginning of January 2018, but it is kind of a level playing field then. As we have seen, the requirements on the investment firms are comparably higher than on trading venues. Trading venues, in many cases, just write in their rules and regulations and require the members to do something, and members cannot do that. And what I said, you probably do not have to implement completely new processes, but you need to check it, and you probably need to update your documentation. And self-assessments, they are a chance to explain your MiFID II compliance to your regulator. And this is a chance, and this is an opportunity we will definitely use, and I would urge everybody to do that. Thank you very much. Thank you for your attention. And this is the end of my presentation.
Thank you very much. Any questions? No questions?
It's so clear.
Thank you very much.
We've had some questions in between.
Just one quick one. I think
Sure.
Sorry, Nick Edelson, Traders Hub. I think there is the disorderly market testing. We haven't found one single firm that had that in place, not one. So that is a new requirement. I agree with you on most of the other requirements. They should be. People should have been doing them, though whether they were, particularly in smaller firms, is a good question.
I think it also, the reason is why that is not so obvious is, what is disorderly market testing, right? So if you're doing stress testing, you find that even stress tests with increased message volume does not contribute to outgoing messages going berserk or something like that, then this is kind of a disorderly market testing.
I can answer, perhaps if I get the chance from the panel, I'll answer that in more detail rather than drag this out with long questions. But we were responsible for the definitions being taken out. There were 3 inconsistent definitions. Our paper to our response to the ESMA consultation, as a result, ESMA very nice smiled at us very nicely and said we fixed it, and they removed the 3 definitions which were inconsistent. There is a definition now, but it's a definition as the absence of fair and orderly markets, and you've got to fit that around MAR. Perhaps I'll say a bit more on the panel about that.
All right, great.
Okay.
So, thank you.
Thank you very much.
Yeah.